Nigeria is entering a new phase of tax reform under the administration of President Bola Ahmed Tinubu. According to the government, the objective is to increase revenue, reduce reliance on borrowing, and support national development. This report explains how the tax system works, who is exempt, who pays more, how much is paid in naira at different income levels, and why public debate around trust and economic impact continues. It is important to clarify a key point from the beginning. Under the new personal income tax framework expected to take effect from 2026, low-income earners are largely exempt from personal income tax. Any Nigerian earning 800,000 naira per year is expected to pay zero personal income tax. This applies to many: minimum wage earners, entry-level workers, low-income employees. This exemption is designed to protect the most vulnerable earners and is a notable feature of the reform. However, exemption from direct tax does not mean exemption from broader economic effects. Once annual income exceeds 800,000 naira, taxation begins on a progressive basis. For income between 800,000 and 3 million naira per year, the amount above 800,000 is taxed at 15%. For example, a Nigerian earning 3 million naira annually pays tax only on 2,200,000 naira, resulting in approximately 330,000 naira in tax. For income between 3 million and 12 million naira per year, the applicable rate on that portion rises to 18%. For income between 12 million and 25 million naira per year, the rate becomes 21%. For income between 25 million and 50 million naira per year, the top rate is 25%. This structure confirms that higher earners contribute a larger share, while low-income earners are protected within the system. Beyond personal income, the tax reforms also affect businesses and investments. Large companies are subject to up to 30% company income tax. For example, a company earning 10 million naira in profit would pay approximately 3 million naira in tax. Capital gains from assets such as land, shares, and investments are more strictly enforced and may be taxed under similar progressive rules. The digital economy is now clearly included. This affects freelancers, content creators, online sellers, and remote workers. A freelancer earning 2 million naira per year from online work may pay several 100,000 naira in combined taxes, depending on allowable deductions. A 4% fiscal or development levy may also apply to certain accessible profits. Even Nigerians who do not pay direct personal income tax may still feel indirect effects. When companies face higher taxes, operating costs often increase. These costs can affect food, transportation, rent, and internet and digital services. As a result, the broader economy adjusts and households may experience higher living costs. The government states that increased tax revenue will be directed towards infrastructure, healthcare, education, security, and debt management. However, public discussion around trust remains strong. Many Nigerians compare the tax reforms with the earlier removal of fuel subsidy. At that time, citizens were told savings would improve economic stability and public services. Instead, fuel prices increased, inflation rose, and living costs became more challenging for many households. Nigeria continued to rely on international borrowing. This history shapes how new policies are received. Economic analysts note several ongoing concerns. Living costs continue to rise faster than wages. The middle class faces increased pressure. Small businesses operate in an environment with limited power supply, security challenges, and high operating costs. Government spending efficiency remains a subject of public debate. These factors influence how taxation is perceived. Most economists agree that taxation works best when paired with visible public value. Reliable electricity supports productivity. Security encourages investment. Lower government overhead builds confidence. Transparency improves compliance. When citizens see results, voluntary compliance increases. Nigeria's public conversation is not about rejecting contribution. It is about ensuring balance, accountability, and economic sustainability. A tax system functions best when growth, trust, and service delivery move together.